There's a moment in every market cycle when something that seemed stable suddenly feels fragile. Not because it collapses overnight or because alarms start ringing, but because a quiet shift begins beneath the surface. For years, many investors have treated silver as simple. You buy it through a brokerage account, you see a price on a screen, it moves up and down, and it feels liquid, efficient, and modern. But here's the question that is slowly getting louder as we move toward 2026. What if the silver you think you own is not the same as the silver someone else can hold in their hand? What if, under certain conditions, paper silver and physical silver begin to tell two entirely different stories? This is not about panic, and it is not about predictions of collapse. It is about understanding structure, because markets are built on structure, and structure determines outcomes. When most people invest in silver today, they are not buying coins or bars. They are buying financial instruments, exchange-traded products, futures contracts, shares and funds that track the silver price. These instruments are designed to mirror the value of silver without requiring storage, insurance, or transportation. It is efficient, convenient, and modern finance at its smoothest. But convenience comes with layers, and those layers matter deeply when stress enters the system. Paper silver is, at its core, a promise, a contract, a representation of silver rather than the metal itself. In many cases, these financial products are backed by physical silver held in vaults, while in other cases they are backed by complex structures involving counterparties, derivatives, and settlement mechanisms. Under normal market conditions, this system works beautifully. Buyers and sellers transact, prices align, and trust holds everything together. The entire system relies on confidence, and confidence is powerful. As long as participants believe that paper claims can be honored, the paper functions like the metal itself. But markets are not static. Demand shifts, supply tightens, industrial usage grows, investment flows surge and retreat, geopolitical tensions influence commodity chains, and central bank policies ripple outward in unpredictable ways. Silver sits at a particularly unique crossroads because it is both a precious metal and an industrial metal, used in electronics, renewable energy technologies, medical applications, and high-tech manufacturing, while simultaneously carrying a historical reputation as a store of value during uncertain times. That dual identity is critically important because when economic optimism rises, industrial demand can push silver prices higher, and when uncertainty rises, investment demand can accelerate on top of it. Sometimes these forces align, and sometimes they compete, creating conditions ripe for structural imbalance. Now imagine a scenario where physical demand begins to outpace available supply. Not dramatically, not in a sensational way, but gradually. Mints report higher coin sales, fabricators report tighter inventories, delivery times extend slightly, and premiums on physical bars begin to inch upward compared to the quoted market price. At first it seems temporary, seasonal, or cyclical, but what if it persists? This is precisely where divergence becomes possible. The price you see on a financial screen is often derived from futures markets, highly liquid arenas where contracts representing large quantities of silver are traded daily, with most contracts never settled through physical delivery because they're closed out or rolled forward before expiration. That is not inherently problematic, as it is how commodity markets have functioned for decades. However, if a significant portion of market participants suddenly prefer physical delivery instead of cash settlement, the entire dynamic changes. The system can handle routine delivery because it is built for that, but it is also built on the assumption that most participants do not actually demand the metal itself, and if that assumption shifts, pressure builds rapidly. This is not speculation without precedent. In past periods of elevated demand, physical premiums have widened, retail markets have experienced temporary shortages, and delivery timelines have stretched considerably. In those moments, the paper price and the street price did not always align perfectly, and that gap, however small, revealed the structural tension hiding beneath the surface of an otherwise orderly market. Looking ahead to 2026, global energy transitions continue, renewable infrastructure expands, electric vehicles become more widespread, and digital technologies deepen their integration into daily life. Each of these trends consuming silver in various forms. At the same time, monetary policy across major economies remains a central theme, with inflation concerns, currency stability, and sovereign debt discussions forming part of the ongoing global conversation. Investors search for diversification, and some turn toward tangible assets. If industrial pull from one direction and investment demand from another intersect simultaneously, and financial market complexity adds a third layer of pressure, the resulting stress on the system could be meaningful. The sheer volume of paper claims linked to silver may far exceed the volume of silver that actually changes hands physically. And while that does not mean the system is broken, it does mean it is leveraged in structure. And leverage magnifies stress during volatile periods, just as surely as it magnifies efficiency during calm ones. Paper silver might reflect liquidity conditions, while physical silver reflects availability conditions. And liquidity and availability are not always the same thing. Liquidity is about how easily something can be traded, while availability is about whether it is actually there to be obtained. In a highly liquid market, prices adjust rapidly, but if physical supply is constrained, premiums can develop independently of futures pricing. Some analysts have suggested that structural tightness in silver supply could increase over the coming years, as mining output is influenced by capital investment cycles, environmental regulations, and ore grades, and since many silver deposits are byproducts of mining other metals, production is not always directly responsive to silver prices alone. On the demand side, emerging technologies may require consistent silver input, and even small increases in industrial usage can compound significantly over time. Here is the deeper issue that most commodity discussions overlook. Markets operate on trust, and financial products operate on enforceable promises. When everything flows smoothly, paper representations are indistinguishable from physical ownership for most participants. But history shows that when stress enters the system, distinctions matter. Not in a dramatic overnight breakdown or a cinematic collapse, but in subtle price dislocations, widening spreads, and delayed settlements. What if the divergence is not explosive but gradual? What if, by the time most investors notice, the separation between paper and physical pricing has already normalized into a new and permanent reality? By 2026, digital platforms may make buying paper silver easier than ever through fractional shares, instant trades, and global access, while holding physical silver involves storage considerations, insurance costs, and logistical planning. Convenience often wins in the short term, but scarcity drives value in the long term. There is also the question of systemic risk perception to consider. During calm economic periods, investors are comfortable with counterparty exposure, trusting clearinghouses, brokers, and custodians while the plumbing of the financial system remains largely invisible. But if broader financial stress emerges, even temporarily, some investors may prefer assets without intermediary layers, and that preference shift alone can influence demand patterns in ways that feed back into pricing. None of this guarantees divergence, because markets adapt, exchanges can adjust margin requirements, producers can respond over time, recycling flows can increase, and new mining projects can come online. But adaptation takes time, and time is precisely where divergence lives. Between immediate demand and delayed supply, between digital pricing and physical fulfillment, between expectation and delivery. Consider also the psychological dimension, because if investors begin discussing the possibility of divergence openly, the conversation itself can influence behavior. Self-awareness in markets can become self-reinforcing. The more participants question the relationship between paper and physical, the more some may choose one over the other, creating the very dynamic they were analyzing. This does not require fear, it only requires curiosity, and that curiosity is genuinely growing. Search trends, forum discussions, and financial commentary increasingly reference allocation, custody, and direct ownership, while digital assets dominate headlines, but tangible assets quietly retain their relevance. Silver, with its dual identity, sits at the center of that quiet shift, accessible compared to other precious metals, industrially useful, historically symbolic, volatile enough to attract traders, yet tangible enough to attract savers. If divergence occurs in 2026, it may not look dramatic on a chart. It may appear as persistent premiums for coins and bars, show up as tighter lease rates in professional markets, or reflect in longer wait times for large deliveries. The paper price may remain active and liquid, while the cost to obtain actual metal tells a slightly different story. And over time, slightly different stories lead to larger and more consequential questions. Are paper markets accurately reflecting physical scarcity? Are industrial users hedging differently? Are investors reassessing counterparty exposure? These are not alarmist questions, but structural ones, and structural questions deserve careful and honest thought. Perhaps the real warning is not about silver at all, but about understanding the fundamental difference between ownership and representation, between convenience and control, between liquidity and possession. In modern finance, many assets exist primarily as entries on ledgers, and that system has enabled extraordinary economic growth and global connectivity, while also creating layers of abstraction between investors and underlying goods. Most of the time, abstraction works beautifully. But when supply chains tighten or confidence wavers, tangible reality reasserts itself, and silver may simply be one of the first visible pressure points because of its unique combination of industrial role and monetary history. The future is not predetermined, but awareness changes outcomes, and as 2026 approaches, the conversation around paper versus physical silver is less about prediction and more about preparation, less about fear and more about understanding the structure behind the prices we see every day.